You probably heard about the tax changes under the One Big Beautiful Bill, and you're trying to figure out which of these changes actually will benefit you and not just sound good on the news. Here's the problem. Most people hear about tax changes, but they don't understand how these changes interact with their income, work, family, or business structure. So today, I'm going to break down the major changes, explain who they actually help, and show you where the real opportunities are and where the traps lie. No hype, just the mechanics. Why this bill matters. Before this bill, we were heading towards a 2026 tax cliff. Under the old law, the 2017 Tax Cut and Jobs Act, most individual tax provisions were set to expire after December 31st, 2025. That would have meant that starting in 2026, you're going to have higher marginal tax rate, a much smaller standard deduction, a reduced child tax credit, a lower estate tax exemption, and expiration or shrinkage of business deductions. The One Big Beautiful Act stopped that. It made a core tax structure permanent and then layered new rules on top. That's the key point. This bill didn't just add benefits, it removed uncertainty. So what that means is the tax brackets, the current federal tax bracket, 10%, 12%, 22, 24, 32, 35, 37 are now permanent. They were scheduled to revert to higher rates in 2026. Now they didn't. As far as the standard deduction, the larger standard deduction is now permanent and indexed for future inflation. For 2025, it's approximately $15,750 for single and $31,500 for married filing jointly. Personal exemption remain eliminated. For most W-2 earners, this locks in simpler filing, fewer itemization, less opportunities without planning. Moving on to SALT deduction, which is going to be a temporary expansion. The SALT deduction cap was $10,000. It is now $40,000, but that's only from 2025 through 2029. After 2029, it can revert. There are income phase out for high earners, meaning that not everyone gets the full $40,000. So planning and timing matters. This is a window, not a permanent fix. And this is a section everyone's waiting for. Worker focused changes, which includes tips, overtime, and auto loan. No tax on tips, the actual rule. Up to $25,000 per year of qualified tip income, which is going to be deductible for federal income tax only, which applies for years 2025 through 2028. And phase out begins at $150,000 MAGI for single and $300,000 for married filing jointly. And it's important to note that tips are still reported income, payroll taxes still apply, and state may still tax tips. So this is not a tax-free income, it's a capped temporary deduction. For overtime pay deduction, deductions only apply to the overtime premium portion. Maximum deduction is $12,500 for single, $25,000 for married filing jointly. And this gonna apply for years 2025 through 2028. Same phase out as the no tips on tax, $150K single, $300K married filing jointly. Remember, your base pay is still fully taxable. Only the extra half-time qualifies. Moving on to the auto loan interest deduction, up to $10,000 per year of interest is going to be deductible, and it applies from 2025 to 2028. And the requirements: personal use vehicle, loan secured by the vehicle, and the vehicle has to be assembled in the US. And the phase out begins at $100,000 MAGI for single and $200,000 MAGI for married filing jointly. And most people, they won't hit the $10,000 cap, but the deduction is real. Child tax credit. It's going to increase to $2,200 per qualifying child, indexed for inflation, and it's made permanent. The refundability portion still remains. There's also a $500 credit for non-child dependent, and this is permanent. And this is one of the few areas where Congress reduced the long-term planning uncertainty. 529 plan expansion. The 529 plan quietly got more flexible. Key limits up to $20,000 per year per child can now be used for K-12 expenses. Expanded use for post-secondary education, certification, and certain workforce training. This makes the 529 more useful beyond just college, especially for families planning the non-traditional education path. For small business and pass-through owners, you have your qualified business income deduction, QBI, 20% deductions on qualified pass-through income, It's now permanent. It's still subject to wage limitation, income threshold, entity structuring rules. This rewards proper S corporation wage planning, entity design, multi-year income coordination, and punishes just valid behavior. As far as charitable deduction, you have floors and caps. Essentially, above the line charitable deduction for non-itemizers, you have $1,000 single, $2,000 married filing jointly, and this begins in 2026. As for itemized charitable deduction, now only the deductible to the extent that exceeds 0.5% of your AGI. This means it's going to make your casual charitable giving less valuable and strategic giving more important. Estate and gift tax exemption is going to be $15 million per individual, $30 million per married couple, indexed for inflation. This level becomes the baseline starting in 2026. And remember, estate planning is not about dying. It's about control, timing, and leverage while alive. So what does this mean in real life? This bill doesn't lower taxes for everyone. It just made the rules more stable. And stability rewards planning, income design, timing decisions, and business structure. If you only react once a year, you'll miss out most of this. If you design your income, these numbers will work for you. Taxes aren't about April. They're about architecture. This bill made the system clearer, not simpler. If you want less stress and more control, you need a plan, not just a preparer. And if you want clarity where you stand with taxes and strategies that make you pay your fair share and not a penny more, that's a quick way to start. Go to my site. The link's in the description. This will help find your tax strategy tier in 60 seconds, so you can see what rules apply to you, where your biggest saving opportunities are, and what comes next in your planning. Because remember, understanding the law is one thing, using it to your advantage is another.